And we are live. Welcome, everybody. What's good, people? Welcome to Sativa Sunday, your favorite stock market show for fundamental, macro, and technical analysis. I'm your host, Zay, the Wealth Strategist, and I want to welcome you on this lovely Sunday, man. I appreciate everybody for joining me this evening who will join later or watch the replay. Trust me, your support goes unnoticed. I really do appreciate everybody that taps in and lock in with your boy. Tonight, though, I got a really good one, man. And I'm gonna give people, those who watching live some time to file in. So before we get into the episode, let me do a couple of quick shout outs. So I want to shout out the Runner family, shout out to all y'all. I want to shout out to my Patreon family and shout out to my sponsor, Kaniba. So want to get that out while people are still funneling in. But yeah, so the title of today's episode, man, the seduction of pessimism. Now, for the runners, we recently read the book, The Psychology of Money, right? And if you haven't read this book, highly recommend it. I highly recommend this book. It was a great book. Now, there's a chapter in this book that, and the reason why I'm going straight in is because we just going to jump right in into like what this is about. So optimism sounds like a sales pitch, and pessimism sounds like someone trying to help you, right? So that's what tonight is all about, right? Can you trust this breakout? So for those tapping in, of course, you already know we're going to go through our breakdown, kind of recap what we talked about last week, what happened, get into this week, but I'm going to really tie it all into just address the elephant in the room, right? So I really just want to jump into it because I like doing my show at 7:30 on Sunday because it gives me an opportunity to kind of look at everybody, see what people are saying, see what people are also thinking as far as going into the market. And there's a common theme, right? The common theme is that, there's a lot of, we recently broke the highs and a lot of people are cautious. And the debt ceiling, right? So that's something we talked about last week and how this debt ceiling could weigh heavy. And so that's going to be a big topic. So I really want to jump into how, right? Let me read a line from the book real quick. I just want to read a line. There's a couple of lines, right? It says narratives about why a decline occurred make them easier to talk about, worry about, and frame a story around what you think will happen next. Usually more of the same. Oh man, where's the one I was looking at? Okay. The short sting of pessimism prevails while the powerful pull of optimism goes unnoticed, right? And it is easier to create a narrative around pessimism because the story pieces tend to be fresher and more recent. Optimism, right? Narratives require require looking at a longer stretch of history and developments, which people tend to forget and take more effort to piece together. So the reason why I'm starting off the show with those pieces and talking about that is because when you look around, say Twitter, or if you look around, say the internet, it's a lot of pessimism, right? A lot of people are like, oh, okay, we finally got the highs. The market is about to crash, right? A lot of people are calling for a market crash. I mean, even myself, I'm a little bit of a skeptic, right? I do believe there's some things in the market that just don't sit right. But overall, right, if you just go and look on it, there's an overall sense of like things, a lot more people are predicting things to like get bad, right? And so one of the things, and this is the line, and then we're going to get into the episode, but it's like, that was the part, right? So if I were to, this is what I wanted to start with. At the beginning of the year, if I would have told you that the market was going to be up 7% and that the NASDAQ would be up 16%, all while we would have a regional banking crisis, we would get 75 additional more bips and Fed rate hikes, inflation would still be at 5%, unemployment would still be at record lows, you would have said I was a fool. You wouldn't have believed me. At the beginning of the year, if I would have told you that the market was going to be up positive and that the NASDAQ would be leading the market and that we was going to get everything I just list, you would have said, Zay, you're an effing fool. Because I'm an optimist, right? When you are an optimist or you have optimism, people will tend to look at you as a fool, right? But history tends to show that over time, optimists actually went out. There's another story in the book that talks about how after World War II in Japan, their country went through a famine. They were basically economically poor. But if at that point, since then, they have transformed their economy. They stock market has went fourfolded. They have one of the best technology countries in the world. And if you would have told someone, if you would have said that back then, people would have said you was a fool. Like there's no way Japan and that America is going to become one of their closest allies, right? Because back then that's when America took them out. So again, optimism sometimes make people look like a fool, but when you're pessimism, it's easier to believe because then you look like a genius, right? If everybody keeps saying it's a market crash, it's going to be a market crash. When it crashed, it's like, oh, he was right? He was the genius that said, oh, the market crashed. Now, often, if you look at it, as many doomsday predictions as we have had, yet if you look at it over time, the market is still up, over 10, 20,000%. Right. Throughout all of the doomsday times we had in the doomsday predictions, overall, the market somehow still manages to go up. But yet it's easier to buy into pessimism. Right. And so tonight, right, I'm pretty sure you've heard all of the reasons why you shouldn't trust this rally and you need to be skeptical and, keep your head on a swivel. And I do advocate for those things. But I'm going to go through some of the things that we talked about last week and point out while it's like, yes, you should be skeptical. But if everyone is seeing okay, we may we're going to get into the technicals, right? We may squeeze to this level or that level and everybody's skeptical. All right. With that being said, let's just get into the data because I want to get into it. So tonight's going to be a really, really good episode. So I hope y'all like my little monologue from the book and all of that. Try to do something a little different. So let's recap last week, right? Well, first, let me go to the comments. Let me say what's up real quick. So Brian Crooks, what's good, man? He was in the chat early, man. What's good, brother? I want to say what's up. Lenice, how you sadoing? My brother Dre, happy Sativa Sunday. What's good, my guy? Dave, what's good, brother? We in the building. Douglas Montgomery, what's up, my guy? King Rel, what's good? Clive said, good job. Great job. Appreciate your information. I appreciate it, man. I got some good stuff tonight. And Black Swan, what's going on, family? Excuse me. Woo. All right, let me get a sip of water. Let's get ready to dive into this information. So let me share my screen. And I tell y'all, man, I'm telling you, I was so hyped for tonight, man. It's going to be a good one. So overall, right, last week, the title that was, we was either going to break out or break down something was brewing. That was in, last week I kind of say, hey, I think we, I said how people, remember I said, the debt ceiling deal, not a lot of people are positioned, what if they get a deal? Not a lot of people are positioned for the upside. Well, you see what happened, right? Well, at the end of the day, right, we got a 1.65% week, and the SPY or SPX finally broke the February high, along with the NASDAQ actually broke the August high, right? So I want to point that out, right? Now, let's talk a little bit about why the rally occurred. So last week I said that the catalyst could be the debt ceiling, right? And that's what it turned out to be. All week we kind of from Tuesday, or let me go to the SPX and go to a daily, right? Exactly. I would say from Tuesday to Thursday, right? The market was rallying on optimism of a deal, right? The main reason that the market was going up was that it was some positive talks. And let me go to boom, there it goes. Oh, my bad. Wells Fargo. So Wells Fargo is going to help narrate this for me. So we came into the week, right? Heading into Monday. Hopefully I can zoom in. You can see that, right? So heading into the week, right? Was coming off a light week, yada, yada, yada. And this is kind of just what I want to skip to, right? That they were supposed to meet on Tuesday and begin negotiation, right? And so it was all eyes turned to the debt ceiling. Let me see, yada, yada, yada. We talked about how they were having some agreements, blah, 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 following, getting to yada, 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 yada. So at the end of the day, kind of just speeding through, it was what we said. So last week I talked about how they were supposed to meet on Tuesday. They put together some teams that were supposed to start, moving forward to our negotiations, and both McCarthy and President Biden were saying positive things, basically Tuesday through Thursday. Now I say Tuesday through Thursday because we're gonna get to Friday, right? But that was, most of the reason behind the rally. Now there's a couple of other things that happened that were overlooked that we probably need to know or talk about. And that was that one, we had a lot of Fed tough talk, right? So they also give us a good breakdown that on Monday, right, we had Atlanta Fed Bostic talk about that it's unlikely that the Fed will cut interest rate this year, right? You had the Minneapolis Fed President Kashkari state that the Fed probably has more work to do to bring inflation down. You had the Dallas Fed press express support for further interest rate hikes, right? Because she believes data supports further action. And this hawkish commentary contributed to a higher interest rate this week. Now, Friday was a big day, right? Because at the end of the day, we always talk about how the only person that matters is really Jerome Powell. And so Jerome Powell had a press conference on Friday, and he kind of came out and was like, hey, he signaled that they could potentially pause by saying, having come this far, we can afford to look at the data and the evolving outlook to make careful assessments, and that the tighter conditions mean that rates don't need to go as high. Right. And we talked about before how the Fed has already reached their terminal rate as far as 5.1 for the Fed target rate. It's basically in line with inflation. Right. So they are at a point where they can pause depending on the data. He also said that in the conference. And again, he's just really not tipping his hand right now. Right. Ultimately, I think it does indicate to a pause. He just can't come out and verbally say it. But we'll see what happens with that. But that was something that the market overlooked. Now, the reason why I want to say the market overlooked that is because once again, we talked about this last week. If you look, the probability, and let me make sure this is updated. Yeah, the probability of them doing a rate hike in June again continues to increase while the market continues to go up. So a little bit of a red flag, but again, the market can ignore and act irrational longer than people stay solvent. But it's just another one of those red flags that we kind of have pointed about, right? Aside from that, right, another thing that we had talked about last week was retail sales and getting data from some of the big box retailers, i.e. being, Home Depot, and all of that. So when we look at the earnings season summary, right, so far, and we got a pretty decent week this upcoming week. So I'm gonna get into that in a second. But just to kind of, get back into our summary so far, first quarter still kind of EPS is up at 77%. The revenue beats are at 68%, right? So still having a quarter that's better than expected, right? One of the things is that overall the earnings are down 3 point. Actually, I think it's a little bit higher at like 2.2 versus the estimate of being 6.6. And again, so it points to, earnings kind of justifying where we're at. And we've been, kind of waiting for what was it going to be that thing that broke us out of the zone. It just happened to be the debt ceiling. And so, right. So now that we have broken out, that was essentially a quick little rundown recap of last week. It get us into the main topics of tonight, right? Which is, can this breakout be trusted? Right now, this is where the optimism and pessimism come in, because of course a lot of people are telling folks that you need to be careful, you probably need to hedge, and but also, right, they're like, well, we can also squeeze to this level, right? Because you have to hedge your bets. And to be honest, at the end of the day, the market is really about probabilities. And it's crazy because me and my wife was talking about it, and we was talking about how actually life is almost about probabilities, and that it's about the choices you make and they lead to certain outcomes, right? So it's like, if you want to live a healthy life, if you choose not to work out or eat right, then the probabilities of you having some type of health defect or something like that is higher than someone who does work out and does eat healthy, right? So your choices lead to certain outcomes, and you can add in probabilities as a way to also look at it, right? So if you want a higher chance or higher probability of living longer, I mean, if you work out, eat right, it kind of improves that probability, right? And so it's the same thing with the market, right? The market every day is unique, and there's a set of unique outcomes that can happen. And there's you should plan for a bunch of probabilities. And that's, essentially what we talk about here. So, with that being said, that leads us into, can we trust this breakout, right? So what we're going to talk about is some of the hot items and then some of the probabilities of the market. Now, again, as we get into this week, we know that some of the hot items are going to continue to be, and let me pull up the Asana here, right? Some of our risk and zoom in on that. Where we at? Because I had to move this up, man. So the hot ticket item for this week is most definitely going to be the debt ceiling discussions, right? Now, recently, Friday, this is where I left off. So Friday, it came out that the talks had stalled, and Senator McCarthy came out and said, "Hey, we're not going to be able to start negotiations again until the president comes back." Right. So now the president came back on Sunday, and recently, before I even did the show, the news come out that negotiations were supposed to start again at 6, and that McCarthy and President Biden are going to talk tomorrow, Monday. So we talked about how they're going to use this as a manipulation game. I went back and watched last week's episode and the one before that. I said that this debt ceiling thing, ultimately, I think a deal gets done. I'm going to say that again. And it may be that 12-hour negotiation thing that they do, but ultimately they're going to use it as a manipulation tactic. So it may be this, they're going to play this back and forth game, this tic-tac game of somebody walking out, somebody need to back. Like, I don't really care. So like, because they do this all the time. Every time that we've gone through this, this is what happens, right? So it's not new to me, right? So the fact that we see this back and forth, like, I know they're going to play this game, man. But I also know that at the end of the day, I believe they will get a deal done, right? They don't want the country to default, right? So the debt ceiling is going to be heavy on the agenda this week, right? Now, not to also to mention, and let me pull up the Forex Factory, right? So also on the calendar this week is on Wednesday, Janet Yellen talks. Now, this is important because Janet Yellen is she's the Secretary of the Treasury, right? So she's the one who's like, yo, if we don't extend this debt ceiling on June 1st, the country going to default. We ain't got enough money in the bank. This is she the one that's like, it's going to be economic chaos and economic catastrophe. And I use these words because I really want people to pay attention to how it's portrayed in the news and the media and how they try to drive a narrative, right? That if this doesn't have, is going to create economic calamity or whatever, it's just going to be this big, great bad moment. Now, again, remember what I said at the beginning of this episode. If I would have told you at this point in time in the market that we would have made it through 75 bips of raising, a regional banking crisis, and inflation at 5%, Fed rate above 5%, and the market's still gonna be up 7%, you would have been like, yo, Zay, you a freaking fool, right? But yet here we are. Like, here we are about to go above maybe 4,200, and people are talking about we might go to 43 or 44. We'll get to the technicals, but again, all that doom and gloom, right? And yet here we are, right? So it's just one of those things, right? But we got to point it out. So my point is, Janet Yellen talks on Wednesday, and of course, what she says could potentially have an impact to the market because she's going to say something about the debt ceiling, right? And that is the hot topic of the week. So that's the reason why I said, she's going to be, that conversation will be kind of key. Now let's kind of take a step back, right? On Tuesday, we get the flash. We get the, I'm sorry, I'm not even going to the PMIs yet. The next big item, right? The next big item that will be hot this week, most likely is going to be the core PCE because that's inflation data. Now, the reason why I'm saying that is because when we go back to the economic data, right, on the Asana, we know that these are the 4 areas that are key: the job, labor market, inflation readings, consumer reports, and the PMIs, right? So when you think about priority and ranking, most likely inflation and job labor market is like 1 and 2. You can really battle to say who's 1A, what's 1B. And then after that, the consumer and maybe GDP, right? Those are same. Them two can battle too, right? But that's basically your top 4, right? And so when we get into this week, right, we have the core PCE. Now, with the core PCE, I'm kind of expecting that to, I guess I'm expecting that to kind of come in line, maybe even low, based on the CPI and the PPI readings, right? Like, I don't, I think that the market may be able to look through this number. Also because we get another PPI and CPI report before the next Fed meeting. So while this number is important because it is the preferred Fed's inflation gauge, right? I do think that the debt ceiling could overshadow this number, right? But it'll be a big number. It'll be something that will ultimately impact the Fed's decision-making process when it comes to June. How much will it weigh? We'll see, right? In the short term. And then back to Wednesday, right? We get the FOMC meeting minutes, right? So that's going to be another data point that goes towards us getting information towards how does the Fed feel towards their monetary policy, right? So again, I think some of the punch or some of the bite from the FOMC minutes is kind of gone because of Powell's press conference on Friday. He basically reiterated what he said in the May conference, which is, hey, we're going to be data dependent, but we're open to basically evaluating due to the current conditions. So he may pause, he may not pause. It depends on all of the data. We'll see, he's not tipping his hand, right? He ain't tipping his hand at the end of the day. And I don't think the FOMC minutes is going to tip their hand. Now, what we can use to assess what might be in the FOMC meeting minutes is what I just read to y'all, which is we've gotten a lot of hawkish talk. So don't be surprised if the minutes come out to be a little hawkish, right? Because they are coming out and talking hawkish. So we'll see if their words line up with their actions when it comes to what the minutes is talking about. Mind you, the minutes is from last month, so we'll see what it is, right? After the FOMC minutes, and we look at ranking, then I was going to say it's going to be the PMI data and the prelim GDP. Now, these don't pack a lot of punch either. I mean, let me revise that. When we think about the pecking order, as far as just things that are going to be on an investor's agenda, this kind of is going to be the last thing that we're looking at, because we know that the economy has basically been going between contraction and expansion. And so when we look at these numbers, right, and we look at the graph, we went to contraction and now we coming back to expansion. So, again, like I've been saying, the economy is bending, but it's not breaking, right? And that's what this information will likely present, right? And with that being said, same thing goes with the prelim GDP, because we already got it before. Usually when you get the revision, it's not that big of an impact. And shout out to Wealth Capital, Charles Schwab. They have here it goes. So the second preliminary estimate GDP usually released about 60 days. This report causes far less market reaction than the advanced GDP, which it revises, right? So don't really got to worry about too much. And then this is the PCE. We also get durable goods on Friday, which goes into GDP as well. So we get like some GDP information. Yeah. Oh man. Another thing I gotta point out that I didn't catch that I should have, and I gotta say shout out to the compound. Watch their last episode, and how crazy their last episode. They had the Arthur Morgan Housel on the compound, and they was talking about some of the stuff that I was going to talk about tonight. And I was like, yo, the synergies, haha, I know I'm on the right track. But I see a question, and I'm going to go to that. Dave said, are we experiencing a soft landing? It could be freaking possible, bro, because let's talk about some improvements, right? Everybody wants to be so freaking negative, and you're missing some improvements that are shocks. One of them is that the National Association Home Builders Market, a measure that measures the home builder sentiment, unexpectedly climbed to 50 in May, the highest level since July 2022, right? Supporting the narrative was the measure for housing starts, which unexpectedly climbed 2.2% month over month, right? We're supposed to be having a housing recession. Oh, it don't look like it, right? Not only that, sales, right? Sales. When the retail sales came in, retail sales actually climbed 0.4% month over month, right? Which was again better than expected. So, man, listen, like I've been saying, yo, we're gonna let the data talk for us, but those are some things that when you can get so caught up in being pessimistic that you miss, some of the, because again, like I said, optimistic, it goes unnoticed, right? It takes a long time. And if I were to come out and be mega bullish or whatever, people would be like, yo, this nigga's crazy. Excuse my language, right? But they would be like, yo, what are you, the economy is about to crash, and it's this, and the debt ceiling is about to default, and companies are overvalued, and blah, like just all of the narratives that you hear of why we shouldn't, right, be rallying, or why the market is wrong, right? A lot of people are like, but the market wrong. Listen, bruh, I read the Disciplined Trader. The market is never wrong. I said this before. It's often opinions are wrong. The market gonna do what it do, right? And people will use whatever reason to justify whatever they believe is happening in the market. I tweeted this once. Yo, when it comes to the stock market, that joint is like a religion, bro, because people gonna believe what they want to believe. So some people are Christian, some people Muslim, some people is Jewish, some people is Buddhist, and that's how the stock market is made up of a bunch of people who have different beliefs. There's people who believe the market ain't overvalued. It's people who believe the market is overvalued. It's people who believe we in a recession. It's people who believe we not in a recession, and that's what makes up the market, right? And so it's just like when you understand that, man, it's funny. So, where was that? Because I kind of went on a little tangent right there. I got all off track, man. So at the end of the day, right? I wanted to get into. So I was basically talking about how like all the basically being negative and optimism. Okay, so positive stuff in the market, right? Let me see. What else did I need to get into? So we got into that macro-wise, gelling, fundamentals. All right, so let's talk about the earnings season, right? So we went through basically some of the big things that are on the week. So let's recap real quick. So economically, we got PMI, we got FOMC minutes, we got Yellen speaking, we get core PCE, and we have the debt ceiling. So that's a pretty heavy docket, right? That's a pretty heavy docket. Definitely could cause some volatility in the market. So when we get to the charts, understand when I'm talking about certain levels, these are the reasons why I believe we can get to certain levels, because we have enough catalysts that can potentially get us there. So from an economic standpoint, definitely a lot of catalysts this week that you got to be prepared for. And a lot of things that can sway the market, right? Now, let's get into like some of the fundamental part of it, right? So now that we're going to get into the fundamental part of it, we kind of already touched on it a little bit with the earnings season continuing to be as positive as it is, right? With so far 77% beats and 68% on the revenue beats, with no 94% beating, right? With that being said, this week earnings calendar is pretty freaking interesting, guys. I gotta be honest. We got some companies that can do some pretty nice movement. So coming in on Monday after the close, you got Zoom, right? On Tuesday, you got Lowe's. Now Home Depot got hit hard. Let's see, and Lowe's kind of rebound, and Lowe's, they typically do a little bit better. You also have BJ's, right? So that will be indicative of kind of get an early read on Costco. AutoZone, beast of a stock, right? You get Williams Sonoma, so that's kind of like what the kind of the more richy folks, right? Are they in a recession? You want to learn more about the consumer, just a different class of consumer, and all these things are important when as an investor, as a trader, you don't really care, right? Trader, it's just all about levels, right? And can it keep going? But from an investor standpoint, some of these things are important, and I like to consider myself a trade investor, where I do trading and investing. So with that being said, this stuff is important to me, right? Now, Palo Alto, after the close, top cybersecurity company, expecting them to do well. Intuit, another great company. We'll see how they do. They do taxes and stuff like that. ADI, right? Analog Devices. That's a semiconductor company. And semi's been killing it. So we'll see how they do. They do a lot of things for automobile, right? Semiconductor space. And you got Nvidia. So that was going. Nvidia is going to be another hot topic this week, right? I mean, Nvidia's been absolutely running beast, right? Up over 100% on the year, and it's just been straight running the market, right? So this earnings is going to be highly, it's going to be a hot item, right? It's definitely going to be a very, very hot item. You also got Snowflake, right? So that's another NASDAQ darling that reports. Let me see who else you got. Best Buy, you got Dollar Tree. Dollar Tree, again, if it's a recession or consumers changing their spending habits, what Dollar Tree says is going, you can use that to formulate some investment ideas or just trading ideas as well, right? Costco, After the Bell, Ulta, Marvell, Workday, Gap, Restoration Hardwood, and then on Friday you kind of finish out with those few companies. So not only right from a fundamental economic standpoint, do we have a pretty packed week? Earnings calendar is pretty packed week. So it's some companies that can do some movement that are in the S&P 500, Nvidia, right? So this is going to be, a very big week, or it has a potential to be another big week, right? And now with that being said, what we'll do is we're going to kind of transition. Oh, 1 second before I leave fundamentals, let's just kind of do a quick touch on valuations, right? Now we do know that we got to pay attention to the valuations, and because it is one of those flags. But here is the market performance year to date, right? And so far, we know killing it is XLC, communication service, up 31%, tech up 27%, consumer discretionary up 18%, and following suit, everything else is kind of just flat, and energy is the worst performer. Again, S&P up 7% on the year, a forward PE of now 19. The NASDAQ is up 16% with a forward PE of 26. And then you got the Dow up 2. The Russell is just now negative. And just a couple of, just something that they said, technicals, equities continue to, look at this, check this out. Equities continue to confound the naysayers by performing much better than most expected, right? Everybody's so pessimistic. The market it just keeps doing it, right? And especially in the light of the as yet unresolved debt ceiling battle. In fact, with a 1.8% gain in the SPX, the technical outlook has improved to its strongest position year to date, right? The SPX remains solidly above the 200, 150 day, currently at 40.73. And this week, it has mounted a rather impressive effort to break above 4,200, a level that has stemmed the index for 7 straight weeks. Falling back below the bear market 35.77 would now require a 15% decline, right? While a rally sufficient to declare a new bull market 42.92, right? That's less than 100 points. Is only 94 points, barely 2% above the current levels. And this was like Friday. So that's just kind of what they was talking about. So with us, we about to get into it ourselves and, really break it down. So before I get into your technicals, there's a couple things that I want to kind of show, and I'm pretty sure most people are aware. Number one is that the NASDAQ, and let me just go to the NDQ and put it on a weekly. The NASDAQ is the one that's leading this thing, right? And when we look at this past week performance, the NASDAQ had a 3.4, basically 3.5% week, and it broke above its August highs, finally catching up to the Dow, right? So the Dow broke its August highs a long time ago, right? Now, the only one that hasn't broken its August highs is the SPX, right? So let me go through. So you got the NASDAQ broke its highs, right? You have the Dow, which is lagging. Now, I want to point something out technically about the Dow and what it's doing. So the Dow is lagging, right, which is causing the sideways market, right? However, I want to point out something important, which is that it basically broke the regional banking crisis candle and tapped the 50-day moving average, and it closed right where it opened here. So could this suffice for a pullback? And if we're going to continue to break out, we need the rally to broaden out, right? And that's what's going to get me into a few other things that I want to point out that I think are going under people's radar that needs to be paid attention to. Because this is how you're going to know if you can trust this breakout or not, right? That's another part of the video. So if the Dow can start to recover and just get back to which is August highs, which is right here, which it's been bumping its head all year, right? That could be enough to help the SPY or the SPX get to its August high, right? And that's just 2.5%, right? Now, at the same time, all you would need is for the NASDAQ is to just stay above its August high, right? It could just do a consolidation week and the Dow can pick up the slack, right? And what does that do for the SPX? That means the SPX can then keep proceeding, right? And so that's one probability, that I wanted to point out, right? Is that you have the Dow lagging, but it's at a critical level. So let me go back to the Dow, right? Because these are the ones that are going to, make that difference. Is if the Dow can keep going, and then we need to look at the small caps, right? The IWM, right? That is one of the indexes that kind of talks about the health of the economy, right? And when we look at the IWM, it attempted a breakout, but it did get rejected on Friday. So if I go down to a daily, and if you can see this, right? And I'll even put it online. So you can see how this area, right? If I highlight that from 175 to 174, has been like just an area of resistance. And so it finally popped across, which is this green area is my 50-day moving average, right? On a daily. And when it got above, it came back down. Now, if I look at this from a weekly perspective, it looks like it could be, I won't say attempting a breakout, but it could be attempting to get back to these are the moving averages on the weekly, on a weekly time frame. And so, you have, a formation of, could this be just a nice base here, right? And then when you just look at it, just from a technical perspective, you have a big open fair value gap up in here, right? And so that is going to be, if the market is to broaden out and we can see the IWM pick up, then yes, right, the rally could continue to keep going, and that's where you see that FOMO and you see the SPX drive up to 4,300, right? These are some of the things that could point to if you can trust it a little bit further, right? Let me see what else I had. I had a few other things that were quite interesting that I thought were going under the radar. Now, I do have to point out, right, some risk, right? So although the market is rallying, I got to say the bond market does not agree with this rally at all, right? The bond market does not agree at all. So this is the TLT. And we all know that the bond market is usually a good representative of risk. And the bond market is definitely not coinciding with the market. It is not it does not believe the narrative, right? So if you look at the TLT, if we look at the HYG, which is the high yield corporate bond ETF, right, represents risk, right? Even if you look at LQD, another investment grade corporate bond ETF, right? So that's the bonds on corporate debt, right? All of that is like pointing down, right? So that is something that is not in sync with this rally. This is something that points to a red flag that I have to point out, right? So I'm basically going to point out a couple of red flags, even though the optimism is there. I'm going to lay out everything, and then this question right here, we're going to figure out. We're going to talk about who's wrong, right? We're going to get to that, Dave. So you got the bond market does not agree at all with this rally, right? So that's one. Not only do you not have the bond market agreeing, you don't have the dollar agreeing, because the dollar this past week rallied. Now I do think that the dollar, right, went in, it rallied, but I think it can do a pullback, right? So if it can relieve some pressure off of itself, and like we see this wick here with this rejection, if this starts to pull back and you see there's a little let me go to a daily because I think there's a gap there. Yeah, there's a gap here, right? If the dollar pulls back again, it could lend itself to a rally, right? It could lend itself to a rally. And so as the dollar pulls back, right, that can lend itself to a rally. But the reason why I was pointing out the dollar is because it rallied last week and the market went up. So somebody, again, like Dave said, somebody's wrong, right? And I hate that this damn thing is up, but it is what it is. I'm almost done. And why do my freaking notes keep doing this, bro? Oh Lord, give me a second, bro. Mess me up. I'm still here. Oh. There we go. All right, I'm back, people. My bad. I just had to go to the laptop computer. Let me go back to sharing computer. All right, there we go. Let me cut that off. All right, so like I was saying, the dollar. My bad. So the dollar rallied last week, and the market continued to rally. Definitely a red flag. But if the dollar pulls back and relieves some pressure, then ultimately the market continue to rally. All right, so that was the dollar. Let me go back to my notes. Let me go to my notes. The VIX. That was the next thing we want to look at. Now the VIX is still at lows, right? The VIX is still at lows. It hit this gap that it has here, right? If we go to a daily, it got into this gap here. It went down. It didn't break the lows, but there's still some gaps even lower down to 1561. And ultimately, I mean, the VIX doesn't look bullish to me. I mean, I gotta say, this doesn't really, from a weekly perspective, it doesn't really present a and honestly, how I'm looking at the VIX now, because now we've addressed this topic a few times, like the 0-day option trading, how does it affect the VIX? And I've addressed this a few times. So really, I just more so look at the VIX as like it's at a level of it's at complacency. It does point to it's under 20, so it's technically a bull market or whatever. But its volatility is very suppressed due to the amount of calls that people are playing on the VIX due to them believing that there's going to be some black swan event. So there's a lot of things that is impacting the VIX. So I don't really, look at it as much or put as much weight on it. But, I do keep my eye on it because it is something that, can give you somewhat of an indication to the market, right? And at the end of the day, right now, the most you could take from it is that, it points to a level of complacency, and that, ultimately, as long as it remains under 20, pullbacks are constructive. Those are buying opportunities. And it doesn't point to, once again, the market being bearish. You got to call a spade, right? So I'm calling the spade a spade and calling it even. And so that's the VIX, right? And then the last thing I want to end it with is just some breadth indicators, right? So let's just talk about a few breadth indicators as far as, can you trust this rally? Now, I mentioned last week we was looking at what was the percentage of stocks above the 50-day and 200-day. And I said we need this number to kind of improve in order for the market to go further, right? So now we have about 49%. That was up from 46, I believe, last week. And we have 47% above the 200-day. And I think that's up from like 45, right? And then the total amount of stocks above the 200-day, just the entire market, is up to 41%, which was about 38 last week, right? And so we're starting now. With that being said, the reason the breadth that we're talking about is something to point out is that we started to see the regional banks start to recover a little bit, right? And we started to see the Russell firm up a little bit. And I talked about how the Russell attempted a breakout, got rejected. We also kind of see the regional banks coming back. That would be a sign that the market could be moving past the region, trying to get past the regional banking crisis stuff, right? And if we have the financials start to just kind of contribute, that's something that could be constructive and pointing towards, a continuation in this rally and ultimately us getting those August highs up at 4,300, right? And so while many do believe that this rally is too narrow, right, and it's too heavy and it's too reliant on the AI hype train, again, the fact that the Russell and the regional banks are starting to firm up and we're starting to see some of a broader rally, you want to be careful of getting too over bearish. And the reason why I say that is because what we looked at last week, right? One of the risks is that there's too much bearishness in the system, right? And I'm going to go here and I'm going to pull up another reason why, right? Is this, right? May 17th, you had 22% of people bullish, you have 37% of people neutral, and you have 39% bearish. Now, there's a lot of people confused, right? It's just about more people confused than it is bearish, right? But either way, sentiment isn't at a point where, again, you can have like a big market crash, right? Also, sentiment could also be at a place where you can get an upside surprise and catch people off sides, right? And if the market blitzes and it starts running and you see people chasing in the FOMO, that's what I'm saying. People off sides, you're not ready. I talked about that last week. If you get this deal, more people were positioned to the bearish side than to the call side. You know what I mean? And so when you see what happened this past week, right? It was all optimism and the market started to run. Whether you want to believe it or not, right? And this goes back to what I said about the trader discipline. People, the market's wrong. Bro, the market ain't wrong. Your opinion was wrong. It just, your timing was off, whatever you want to call it, however you want to justify it. But the market did what it did, right? It is what it is. So, as we get into this upcoming week, right? And we looked at, the breadth, we look at all of that. It leads me to a couple of probability outcomes, right? And so when I look at SPX, from a weekly perspective, and we break it down, and we think about what are some of the weekly probabilities that the market has, right? Number one, right, we could always look for weekly continuation, right? And so ultimately, the market could pull back, all the way down to like 41.35, right? If I just put it on from a pivot perspective, we would say as long as 41.70 holds up, and we could even come down into this area about 40, right up in here, 41.35. When you look at these pivots, you just use this pivot. That's 41.36, right? We could come back into this area and retest that. And all of that could, that's just creating a lower high at the end of the day, right? So from an SPX perspective, if this week coming in, say Monday, Tuesday, you get a little bit of a pullback, you know what I mean, down to these areas that could be constructive, right? Because that's towards the end of the week, news of a debt ceiling deal or whatever starts to come in positive. Again, the PCE number is on Friday. If I'm expecting that number to be low, again, people may not be positioned for it. And you get an upside surprise, right? The number came in 4.9, so why wouldn't core PC be low? So if you get a negative start to the week, then I'm looking for a strong finish, right? So that's some support. So support is 41.54 down to 41.36, right? And even 41.80. Once we get above, it's simple, right? For weekly continuation, we got to get above last week's high. So from an SPX standpoint, I want to see the market get above 42.12, right? You get above 42.12. Now we're talking about we are in a value gap, right? Or a value imbalance. I'm sorry. And that runs from technically, and I actually pointed this out in the episode before. I was like, there's a bunch of gaps that essentially the market is going to gun for. This one runs from 41.95 to 42.28, right? So if we get above the 42.12, then obviously the next level for me is I'm looking at this lower wick and I'm looking at this body. So that's 42.18 and 42.12, right? And then once you get there, there's some, there's a gap and some open space, and then there's some gaps up here, which essentially gets the market to about 42.80, right? And we just talked to, you just seen on here how he talked about, listen, it only takes 94 points, right, to get to the 42.92. We just broke it down ourselves, and we know that there's some open gaps and open liquidity to the upside. The market has finally broken out of a range that we've been in for 6 weeks, right? And this is a pretty strong candle, right? And you don't necessarily want to jump in front of this train just yet, because not all of the signs are there, right? It's way too much pessimism in the market, for just this sudden turnaround at the end of the day, right? And when you break down some of the signs, there's some things that point to this rallying continuing, and the red flags are just red flags. They aren't like caution yet. It's just like, all right, this piece is at him. It all hasn't come to a picture to where it's like, okay, shit is really about to hit the fan. We get in there, but it ain't all the way there yet, right? It's some things that are preventing it from getting there, and it's just taking its sweet time. What other thing that I had? Damn, I wanted to share with y'all before I go to any. If you got any questions or anything, drop it in the chat. But that's pretty much it. This a nice episode that I wanted to share. All right, let me go back to my notes because I think I left one thing out. Dang, man, I think I might have forgot, y'all. I think I did forget, man. But in the meantime, let me go to the questions. And I'll see if I can try to remember that. Dang, what was I about? Let me see. Maybe it was something on here. Dang, I can't remember, y'all. I can't remember. So Dave said, "Are we experiencing a softer landing?" We're gonna see, brother. Artificial intelligence, yes, sir. That is a narrative that is really driving the market. I think he said he's building. Yep, he's currently building. They built more houses in the South this year than the last 20 years. So this one was talking about the housing market. He's currently having the house built now, and then who's wrong? So yeah. No, so again, man, I appreciate all those who tapped in with me tonight. Again, I'm sorry for that. I should have deleted. I didn't delete the last episode, so that's why my camera went full like that. But no, yeah, man. I just broke down some scenarios, some probabilities, right? That we're looking at, a few levels, just some things as far as it's a heavy week, right? But again, I want to recap it and bring it home. Is that I know I went through a bunch of stuff, right? So we went through some macro stuff. We looked at some fundamental things as far as the valuations. We looked at technicals, and it could be confusing, right? It could be a lot. Let me actually bring this off. Stop sharing. And I know it could be a lot, right? It could be like, man, how do you see? What do you use? What do you believe in? What do you like? It's just so much. So the reason why I titled tonight episode "The Seduction of Pessimism" is because the thing that stuck out to me was that, and it really hit home, is that when people are optimistic, it sounds like a sales pitch, right? So I hate to say it, but when people are optimistic, they're often looked at as a fool or crazy, right? You don't know what you're talking about, right? Why should I believe you, right? But if I'm pessimistic, sounds like I'm trying to help you, right? If I'm saying, oh my God, the market's going to crash, you need to sell everything, you're like, oh snaps, this person must really know something, and I need to listen. And oftentimes, that negative outlook can affect, you can miss the bigger picture, right? Because again, I gave some examples of how, and the best one is just the market this year, right? And it's crazy because when I look back at the beginning year episode that I did, I said, the best opportunities would be go long XLK, the chips, everything that's running, right? And even back then I was skeptical, and a lot of people were skeptical, right? Because at that point in time, the Fed was on a rampage, raising rates. We was hearing about layoffs. When you just think about that point in time, we was in the beginning of the year, it didn't look good. It wasn't a positive environment for those type of stocks, right? So recommending those stocks, people said you was crazy, right? No way. Oh, it's everything, Amazon's going to 60. Everything's coming back down, right? But if you would have said, no, bro, in 6 months, Nvidia going to be up 100%, Meta going to be up 100%, Tesla going to be up 100, everything going to be up 100%. Like what they would have said you crazy, right? And so I say that to say that you need to trust yourself and what you see and like what you know, and don't let other people's pessimism turn you away from something that you actually see that can be a positive, right? It's a lot easier to sell pessimism, and it's a lot of videos, and people are talking about the market's about to crash and this and that. It is so, and we get tied into that, right? And because it's easier to talk about, it's it's the hot topic, and it's like, oh, when is you want to be so ahead. But if I was to come out and be like, yo, nah, this year the market's gonna keep doing this thing, and we're gonna get past all this. Don't worry, just keep throwing, putting your money and buying, like here you go, right? Go long in resilient companies, you know what I'm saying? And you're gonna be good. I guarantee you, they're gonna tune me out. People are gonna be like, dog, this dude don't know what he talking about. You know what I mean? He has no knowledge about what the stock market is. And when you think about it, and it comes from our roots of within the debt-free community, that's like everyday millionaires are built because they just put money in the market month after month. They don't care. It's all about time, man. And that's one of the things he talks about in his book. It's all about time and compounding. Matter of fact, in that chapter of Seduction of Pessimism, this is exactly, and then I'm going out on this note right here because he talks about time or compounding. And this is page 186. Growth is driven by compounding, which always takes time. Destruction is driven by single points of failure, which can happen in seconds, and loss of confidence, which can happen in an instant. Right. And then he goes on and says it's easier to create a narrative around pessimism because the story pieces tend to be fresher and more recent. And optimism narratives require looking at a longer stretch of history and developments, which people tend to forget and take more effort to piece together, right? And that's exactly what it's all about, right? In episode I talked about how the real secret to Warren Buffett's wealth was time. Dude been investing for 60 years. You know what I'm saying? That's ultimately been his secret. You know what I mean? At the end of the day. And so, I just want to leave this episode off with that. Yes, we made new highs. Should you be cautious? Yes, there's risk in everything we do, right? But just be careful of always falling for the seduction of pessimism, right? So I appreciate y'all rocking with me tonight, man. I hope y'all enjoyed this episode. And I hope I offered a different perspective for you guys to take a look at the market. I would ask that you press the like button, share this with somebody that that is into the market. And other than that, man, I can't wait to catch y'all next Sunday when we talk about what happened and where we go. Until then, y'all stay blessed and peace out.